risk to reward ratio can determine how profitable you are as a trader. It doesn't matter if you're a beginner, it doesn't matter if you're intermediate, it doesn't matter if you've been doing this for a very, very long time. Your risk to reward ratio can make or mar your trading journey. Hi, welcome to the Satoshi African Academy channel. Here we are after spreading crypto adoption by education. I'm Uncle Wealth and I am welcoming you to today's topic. So today we are dealing on the risk to reward ratio. Now, when it comes to risk to reward ratio, what you need to understand is that for every amount that you risk, you should be willing to make a reasonable amount out of that risk. So, think of it like this. Let's say you were playing a video game and you were giving, a certain number of lives in that video game. One of the things that you do if you're a gamer is that you're going to consider for every, risky move that you're about to take, you consider the potential gains in that particular move if it becomes successful. So you consider the gains that you get and how valuable those gains are. So once you understand that, you see that it will help to determine what you're going to do. It's going to determine your move at that particular point in time. So risk to reward ratio is basically that. So let's say you enter a trade and you're entering a trade with $1,000. Now, if your risk to reward ratio is a 5-to-1, your risk to reward ratio is a 5-to-1. You can call it RR. Some people say it's RR. That's risk to reward ratio. Some people just call it RRR. So, but let's say you enter a trade with $1,000 and your risk to reward ratio is a 5-to-1. It means that for every $1,000, you are looking forward to gain $5,000 out of that particular move. So, if you are using a 2-to-1 risk to reward ratio, it simply means that for every $1,000 you risk, you are looking forward to get a $2,000 reward. If you're entering a 3-to-1 risk to reward ratio, it simply means that for every $1,000 you are looking forward to get $3,000. Now, here's the thing with risk to reward ratio. What you need to understand is this. Not all the risk to reward ratios are the same. Some carry more weight than others, and you can see it being reflected here. So, with a 2-to-1 risk to reward ratio, you need to understand that for it to become profitable, you need to win 50% of your trades over time. So, for every 10 trades you make, at a risk to reward ratio of 2:1, you need to win 5. Now, if you have a risk to reward ratio of 3:1 RR, and then you need to understand that your winning rates will be lower for you to turn in a profit. So you need to hit at least 45% wins, 45% wins to be able to pull off a profit. Now, for a risk to reward ratio of 4:1 RR, it simply means that you need, a winning ratio of 30% to become profitable. I think that's what we should use here. So we say profitable, 30% wins to be profitable. So we write that here, 30% wins profitable. And here wins profitable. Now, for a 5:1 risk to reward ratio, you will need to have 20% winning rate from your trades to be profitable. Now, I'm going to tell you something that you need to understand, and it's very practical. The higher the risk to reward ratio, the more you will need lesser number of trades to be profitable. So, think of this. At a risk to reward ratio of 5:1, you need just 20%. 20% of every 10 trades you enter. Over time, you need 20% wins to be profitable. So, if you understand this, then you need to know that you're going to have to lose 80% of the time. So, if you have a particular risk to reward ratio that you choose, you also need to make sure that most of your trades fall in that range, that risk to reward ratio range. Now, this is textbook style. But I'm going to tell you how it is in the market. Now, when you are on the charts, you need to understand that most times things will not go textbook style. You're going to have periods where your risk to reward ratio, as much as you want it to be a 1:3, a 1:4, the market conditions at that particular time will not favor that. Sometimes you may have to see a risk to reward ratio of 0.7 to 1 or more. In fact, if you're using, say, the double bottom strategy, sometimes you may see that a risk to reward ratio of 0.4 to 1 is what you will see. So, what you need to understand is this. The point I'm driving here is that your trading style, the particular method that you're using should favor whatever risk to reward ratio that you choose. So, if your risk to reward ratio, doesn't favor that particular trading style, that entry model, you just have to be realistic. But try to aim for a minimum of 2:1, because at 2:1, if you put in $1,000, you know that your aim is $2,000 and you make a profit of $1,000. So in this case, for every 10 trades, you can lose 5 in a row. If you lose 5 in a row, you will see that the remaining 5 will be profitable by the time you have 5 successful wins. So Basically, that's that with risk to reward ratio. So your risk to reward ratio is basically, the ratio that tells you how profitable that risk that you're entering is going to be. So it doesn't matter if you're using leverage or not, but you need to factor in that the higher your risk to reward ratio, the less number of trades you will need to win to be profitable. But your market conditions, the market conditions at the time of your entry, the time of your trade, will play a huge role on how high the probability for your trade to hit your TP is going to be. So, a 2-to-1 risk to reward ratio is most likely to hit than a 5-to-1 risk to reward ratio. Another thing you need to understand is this. If you are, because we have been there as a beginner, one of the things you stress yourself over is that, hey, I've had losses in a row. So you're just trying to, get just small win to make yourself feel good. What I will tell you is this: it is better for you to stay away from the screen at that particular point in time. Take a day off, take 2 days off, take 3 days off, go and touch grass, go and enjoy yourself offline, then come back to review your mistakes instead of you to make impulsive decisions that will, mar your trading journey. It's very okay to take a break. If you notice that you are having, let's say, 3, 4, 5, 6 losses in a row, take a day off. Because at the end of the day, what you want to do is to protect your capital. What you want to do is to preserve your capital. Because on this journey, we are dealing with probabilities. It is not trading is one of the most uncertain businesses in the world that can be very, very rewarding. You have no control over the market. The market will do whatever it wants to do. Your job is to manage your risk. Your job is to make sure that every $1,000 you put in, you should get a reward that is very, very investor responsible. So try to aim for a minimum of 2-to-1 risk to reward ratio. But factor in also that even though your trade, is based on a 2-to-1 RR, you need to factor in that the platform that you are using, they are going to have fees. So if you're aiming for an absolute number, we have been there, we have seen all these things. If you're aiming for an absolute number in your RR, keep in mind that the platform is going to charge you fees. That is why they are into the business. They're going to charge you fees for using their platform to trade. Then another thing you need to consider is also the behavior of the assets you are trading. Some assets, when you enter your trade, when your particular, your trade goes live, if you're using a limit order, let's say you're looking at entering a trade at $5 and then, the price was at $6, it came down, to $5 and then it picked your order. You're into the trade. What you need to understand is that there are fees attached to each trade. So, if you are being charged for entering the trade and you are charged for also exiting the trade, you are also charged a funding rate for that trade. Keep in mind that all these fees can balloon over time. Now, if it is forex, You can also be charged for, holding your trades overnight. So your risk to reward ratio, it doesn't have to be an absolute number. Just factor in, when you are drawing your using your loan tools, drawing your lines, your zones, factor in fees, because these fees can make or mar your profits. If the platform is also charging commission, they can also make or mar your profit journey. So factor that in. Factor that in whenever you are entering a trade. So that's basically it with risk to reward ratio. So with a 5-to-1 RR, your $1,000 can turn into $5,000. With a 2-to-1 RR, your $1,000 can turn into $2,000. With a 3-to-1 RR, your $1,000 can turn into a $3,000. So with 2-to-1 RR, you just need 50% wins, and then you become profitable. With a 3-to-1 RR, you need 45% wins to be profitable. With a 4-to-1 RR, you need 30% wins to become profitable. With a 5-to-1 RR, you need 20% wins to become profitable. And then understand this, we are dealing with probabilities here. We are dealing with probabilities. This is a business that deals with probabilities. You are not in control of everything. The only thing that you're in control with is your risk. The amount that you're willing to expose to the market. So you are saying, hey, go out there, make me money, and come back. So that's where your stop loss is important, because your stop loss is how much you're willing to lose if that trade doesn't go your way. Now, I hear some people say, they trade without stop loss. Well, people who trade without stop loss, most times I just laugh, because they fail to admit, to tell people that sometimes there can be spikes in the market. If there's a spike in the market and you are also using leverage, and your risk amount is not able to withstand that spike, even if the trade is going to go in your direction, that spike can take you out. It doesn't matter if you're using isolated leverage, or you're using cross leverage. A spike in the wrong direction can have a drawdown that takes you out. So your risk to reward ratio should work in line with your stop loss. Your stop loss should point you. Make sure that you factor in a drawdown, because at the end of the day, people are placing trades at different prices, different price levels, with different intents. Some are scalping, some are swinging. So whatever is your intent, understand that the market is going to do what it's going to do. Your job is to ensure that your strategy over time becomes profitable. So if you're entering 10 trades, you need to have an idea of your winning percentage to turn profitable. Factor in the fees. Are you a market maker or a market taker? There are going to be fees. Most platforms charge higher for a market taker than a market maker. So factor in those fees. The fees are the commissions, the funding rates of the platform that you're using. And also keep in mind that funding rates for one asset will not be the same funding rates for another asset. The only thing is that your level as a trader, whether it will determine the level of fees you are charged. So let's say you are at the basic level, on the popular, the top one or two, the first or the second exchange, first or second top exchanges. One of the things is that at the basic level, most times they charge you 0.1% fees, for entering your trade and exiting your trade. But the funding rate will be based on the asset. So if it's an asset that is on a very very fast rise under 24 hours, it has a very strong trend. 1 day, 2 day, 3 days. One of the things is that the funding rate will definitely, sometimes climb and spike as high as 2%. Sometimes I've seen a funding rate of an asset that even climbed up to 2.5%. So the platforms, have to, rearrange the funding rate so that the spot price, will not be far away from the, the derivative price. So all those fees add up. If you're using forex, if you're trading forex, for forex, the commissions will also add up. So the spread will add up. So factor in all those things when you are choosing your risk to reward ratio. And if you notice that you are having back-to-back losses, it is very very okay to take a day or two off. Go and enjoy the sunshine, go offline and rest. When you come back, you now come and analyze your trade and find out with a clear mind what did you do wrong. And then, as someone who is interested in learning, when you see what you did wrong, you now write it down. And then when you see the same scenarios, you make sure you don't make that same mistake you made. That is how you improve. That is how your risk to reward ratio, works in your favor. So that'll be all for today. So I'm wishing you profits, and share this with your fellow beginner trader. We are after spreading crypto adoption across Africa, and we will see you in the next one.